As tomorrow we are getting the next inflation reports for the month of August. Also, in this same month of September, we're going to have the next Federal Reserve Board meeting when they're going to decide on the next interest rate policy or the monetary policy. In other words, what are they going to decide when it comes to the amount of, the levels of which they are going to increase interest rates? Is it going to be a 75 basis point or 0.75%? Is it going to be lower, 25 basis points or 0.25%, or a lot more higher, maybe 100 basis points? This is what pretty much people are trying to figure out. But I think we can have a pretty much indication as tomorrow we'll get, this inflation report, which I believe is going to be positive for the market because we already have signs of inflation peaking, meaning this is going to just solidify the idea that inflation is now going back down. Remember, inflation in 2022 is the biggest risk facing the market, according to both, the big boys in Wall Street and also corporations, because high inflation means lower corporate margins, which means lower profits, which means not good for the entire environment, economically speaking. Now, as an investor, you want to make sure you position yourself to put your money to work for you while you're sleeping. That is the ultimate goal in order to be financially free. In the stock market, it's easy to do this when you can anticipate stuff that are going to happen in a sector or others, depending on where or how these sectors will be impacted, positively or even negatively by, the US economy indicators or what the Federal Reserve might do or anything else. So kind of, getting a little bit higher than myself here, I can see few sectors where you can put your money to work for you as we get the response from the Federal Reserve. And I'm going to go a little bit into the details, and I'm going to give you my thoughts on these sectors, all right? Because I do believe if you position yourself, early enough, you can make solid gains as we head into the later part of, the last quarter of this year. So here's my thought process. I'm looking at inflation going back down, and I'm also looking at what the Federal Reserve said in terms of we're going to do pretty much everything we can do to bring inflation down. Now, increasing interest rates is not the only thing that will bring inflation down, because inflation, it's part of the natural cycle of what we went through with the economy since the lockdowns up until now. So it was expected, and I think people were kind of thinking about the worst, which is usually what is happening in the stock market. But if you are patient and disciplined enough, you can actually, see through the lines, see through the cracks, and see where you can make money. All right. So the Federal Reserve is also looking at these numbers. But the difference here is the market is looking ahead, but the Fed is looking backwards, because all of these indicators are looking backwards. The CPI, the PPI, the PMI, the sentiment, the sentiment expectations around inflation. All of these reports are coming from economic agencies around, the country, and they are 1 month behind. So they are not reflecting the real-time economy. When I go and pump gas into my car, I can see that I'm not paying $57 to have my tank full or filled out. I'm now paying $20 less. So it tells me that, hey, these prices are going down. But why the Fed will be so much aggressive? Because they are looking at these, lagging indicators, all right? And by doing so, we have smart people, billionaires warning the Fed around not overdoing this correction, because they might push the economy into a chaos by breaking something. And that will call depression. Now, because I also know these are smart people at the Fed, I think what they're going to do is they're going to look at these, both the lagging indicators and both the real-time indicators, and see that, hey, maybe we don't have to be this aggressive. And then maybe when they come in September and say, you know what, instead of doing 75 as the market was expecting, we're going to do 50. Or maybe we're going to do 25 basis points in September, in October, and in November or / December. Or maybe 20 or 50 and 25. So something on around that combination, because if they stop, then it will give a signal to the market that they think the job is done while the job is not done. But I think they're also kind of in la la land when it comes to bringing inflation expectations to 2%, which is what we want to be, but it's going to take some time to get there. All right, that's what I think they are kind of in la la land if they think they can bring to 2% as quick as they want, because it's not going to be the case, simply because that's how economic cycles work. All right. Now, if we are not in a recession, that's going to be difficult. But if they want to cause a recession to do so, definitely it might happen. Now, going to how I can see some of these sectors in the market being impacted. Well, first of all, interest rates or the Federal Reserve not being as aggressive as the market expects will mean that, the dollar will drop, so you can short the dollar. DXY is the ticker for that. It means interest rates will drop. And when interest rates drop, because expectations for the Fed to do something aggressive or pulling back, stocks go up. So you can buy in the S&P 500. But if you want to get in those sectors where, you will have the most amount of gains, I can definitely see that happening for the tech sector, technology sector. Why? Simply because there is a correlation between the two. Whenever interest rates are going up, you want to make sure, whenever interest rates are going up, technology sector as a whole, your Teslas, your Apple, your Neos, your Nvidia, all of these guys will pull back because interest rates are going up. So with interest rate going down, it means this will definitely go high, especially with prices being slashed since the beginning of this year. So this ticker, for example, VGT, is the Vanguard Information Technology Index Fund. You can definitely get this, and you will see that for the last 6 months, we are kind of on a recovery mode because inflation is going back down now, and people are thinking that the Fed might not be as aggressive as it needs to be. So we may get back to these levels that we saw back in August 15, which is kind of what almost 8% to where we were at the height of this year. But still, year to date, we are way below where we were in terms of 22%. So we still have some way to go. So that's why I think as inflation expectations go down, I definitely see these to start trending back up, maybe to these levels that we started off of this year. Another a sector I'm seeing here is the crypto sector. Now, crypto might be something that a lot of people are fearing because you think it's a lot of volatility, and it's true. But in order to kind of find the right balance between risk and reward, I'm looking into ETH. ETH is the Grayscale Ethereum Trust. So it's pretty much like you're buying Ethereum, which is the second largest cryptocurrency market token out there in terms of market shares and capitalization. So whenever people are thinking about Bitcoin, the next one is coming, it's Ethereum. And it has a lot of potential, especially in when you think about what we call the merge, which is going to make it a lot more fuel efficient. Energy efficient. And this is something that has been drawing a lot of people out or preventing people from getting into crypto. So as the merge happens this week, of September 13, then I can see, this starting to trend back up very, very strongly. So I'm also looking at this as another ETF to get exposure into the gains as we get into the later part of 2022. And then finally, I'm also looking at the energy sector. The energy sector is definitely poised to boom again because not only we are getting into another huge travel demand season, Thanksgiving and Memorial Day, but also because we're getting into the winter season. This winter season is going to be really tricky because of what is happening in Europe with the war between Ukraine and Russia. And because of that, there's going to be a spike into at least some of these gas or oil prices. It may not be as huge as some people are thinking. Maybe we'll get back to, $150 a barrel of oil. But I think we may get back to those mid-90s, which is still going to not crash the economy into a recession. All right. Now, in order to get exposure, you can definitely buy USO. But I'm looking at these 3 stocks that just got upgraded recently by some of the analysts in the market. So GTE, right now really cheap because it used the fair value, meaning if you look at the company assets, if you look at what the company is valued, it's around $3 a share. So right now you're looking even at a 60% increase if we were to go back to those $3 a share. So really cheap right now to get in. And then SM Energy right now trading at 46, but the highest has been 55. But the price target here is really around 60 or 65. So huge price improvement here if you get in. And finally, Apache, another producer, highest so far $52 a share, but the price target are around 60. So $20 per share price improvement or upside potential if you look at these current levels right here. So these are definitely not on an exhaustive list, meaning there are way more better ETFs, better stocks, better sectors to look at. But this is just what I've been trading for the last 2 years and where I see, looking at my lecture or analysis or reading of the economy and what the market are the next market direction. So feel free to throw in the comment section anything else I may have missed or anything else that you are also in and see going up as we get into December or the last quarter of this year.